We got some big news for SoFi stock investors as the company reported segment growth in key technologies and key strategic imperatives that is making the company less risky for investors. And a reduction in risk has huge benefits for SoFi stock investors because the upside is already very large. And so if SoFi can convince investors that it's less risky, then investors will be more interested in owning this stock. And I'll talk about the details of why that's the case in this video here. SoFi has been working aggressively to decrease its dependence on making loans for its own balance sheet. The lending platform business is growing robustly, and on an annualized basis, they're now generating over $1.6 billion of fee-based revenues. This is in addition to the loan platform business. That's reflecting a deliberate diversification of our business towards more capital-light revenue streams. And that's a key here, capital-light revenue streams. This makes the business less risky. If you can imagine, when SoFi makes a loan and keeps that loan on its balance sheet, services that loan, if there's a default or if there's an increasing percentage of defaults, those are losses that SoFi absorbs. It's on the hook for those losses. It lends out, let's say, $1 billion. And if there's a large increase in defaults, let's say out of the $1 billion, they only get paid back $900 million. That leads to $100 million in losses on the loans that they make. That offsets whatever rate of return they expected to receive when making those loans. And so it decreases the company's overall profitability. It also decreases the company's capital remaining to reinvest in making more loans. So by originating loans on behalf of third parties, SoFi still generates that income from making loans, but it generates that income in an asset-light way, in a capital-light way, where it's the third-party lender that's taking on the risk of lending that capital. And if there's defaults, then that third-party lender is the one that loses the money, not SoFi. In some cases, SoFi does retain some stake in those loans that it sells to third parties. And that's part of the arrangement because these third parties, they want SoFi to have some skin in the game, so that SoFi will be more interested in the due diligence process, in making more effective loans, in making loans and pricing them effectively so that the risks are offset by higher interest rates to account for those elevated risks. Click the link below to watch the full video.